Hi, everyone. This is Jason Burak of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. I absolutely love his videos on the gold market, global macro. He did a great podcast for many years with Real Vision TV. He co-founded Real Vision. He's a former gold fund manager. Also writes the newsletter, things that make you go, I find myself using that phrase a lot. It's just so perfect for everything that's happening nowadays. Grant Williams, thank you for joining me again.
Hi, mate. Good to be here. How are you?
So, Grant, things have just gotten crazy in the last month. First week of January, the oil market just started going crazy. I was getting information from my friend trapped in Wuhan for months now. I've been hearing about this stuff. I was warning people about the airline stocks, the cruise ships, the oil market. Do you think what's happened in the last month with all the different contacts you've talked to with the credit markets, with commercial paper, with the money markets, with bond markets, investment grade, junk bonds, do you think it's worse than 2008?
Look, for me, undoubtedly it is. I mean, 2008, we had a liquidity crisis turn into a solvency crisis. We have the entire global economy stopping on a dime now. And that's way worse than 2008, I think. The Fed and the governments and the central banks all around the world have come out swinging. And I think the speed with which they've done that tells you how serious they think this is. There was no messing. They didn't waste any time at all in many cases overstepping their mandates. But that was all forgotten. And what do we get on the big Fed bazooka day? We got a market that fell 12, 13%. That would not have happened previously. If this was a problem that was salvageable by throwing money at it, they've thrown enough money at it to solve the problem, and it isn't solved. And today, as we tape this, the market's down another 3-4% after having a good rally into the end of the month, end of the quarter, which is important to understand. First day of the second quarter, and everyone's dumping everything again. I think if you look at those initial jobless claims, which people have kind of shrugged off, even though, the number's almost fast enough that you can shrug it off when you look at the chart. But of course, these are real people losing their jobs. And, if the government backstop everybody, which they're going to have to try and do, all the people who are getting laid off, if you think that all the companies who've laid people off are going to hire all those people back again, when they think the coast is clear, you're out of your mind, because they'll be shaken. They'll be wanting to build up reserves, build up cash reserves. So this is going to be with us for some considerable amount of time. And the markets were way overvalued, given the growth we had before this. We had very anemic growth pretty much everywhere across the Western world, and even the countries that have been doing the heavy lifting, like India and China, in recent decades, were struggling. But now, when you see these numbers of minus 30% quarters from more than one of the big investment banks, something extraordinarily awful is coming this way. And for markets to be bouncing in the face of it because they think that it'll be fixed by stimulus bills and multi-trillion-dollar infrastructure bonds, or whatever the cute word today is, or even helicopter money, which obviously we now essentially have, is missing the point and doesn't perhaps understand history. I don't think that throwing money at this problem is enough, and people are way too fixated on the equity market, for example, which is performing way better than the bond market. I'd be paying much more attention to the credit markets.
Yeah, I agree. I don't think throwing money at the problem is going to fix things this time, because the global supply chain, from what I can gather, listening to interviews from different experts, the global supply chain is broken. It's going to take some time to fix. With the tariffs, the trade war with China, a lot of companies were already deciding that eventually they were going to have to move factories out of China. Now this is going to accelerate this process, but they can't do everything in a short amount of time, in a couple months, 6 months, probably even a year. So all these things are going to take time, but the central bankers think that they can paper over everything. All these bailout programs, I think you touched on this briefly, the bailout programs seems to me, they were all rolled out faster than from what I remember in 2008. So they allowed Lehman Brothers to fail, the problems with Bear Stearns, AIG, and then the bailout programs came out. The bailout programs seem to have rolled out a lot faster now. And I think the jobs issues that you brought up, from what I can gather, I have a lot of podcast listeners all over the United States, and other countries. And they were sending me messages that they were trying to apply for jobless benefits, unemployment claims on their state website, and the websites were broken every day for a week. So I don't think the jobs numbers reflect anywhere near the real amount. I think we're at least a couple weeks away, maybe a month, from getting a real sense of the amount of people that actually lost their jobs.
I completely agree.
Also, I saw an interesting point there with the National Restaurants Association. It sounds like 11, according to their estimates, like 11% of all restaurants here in the United States will be gone. They estimate that they're never coming back.
Yeah, well, it's behaviours are going to change after this. I think we, I've said this before. There is going to be a pre-virus world and a post-virus world, and the post-virus world is going to look very, very different. It is going to have helicopter money in it. It is going to have $10 trillion on the Fed's balance sheet. It is going to have countries printing money the world over. It is likely going to have inflation, and behavior, I think, is going to change significantly. People will be scarred by this. This will change a lot of things that we do, the way we behave, the way we interact with each other, the way we spend our money, the places we go. It's going to change everything. And I don't think people are taking that seriously enough right now.
Okay, you said $10 trillion on the Fed's balance sheet. We're a little over 5 trillion, 5.2 trillion now when we're recording this interview on Wednesday, April 1st. So how quickly are we getting to 10 trillion? Are we getting to 10 trillion in 12 months? Are we getting to 10 trillion in less than 12 months? What would be your educated guess at the pace the Fed is on now?
Well, look, to be honest, there's no point in having even an educated guess at it. We're going to get there. The pace is going to depend on how desperate they become. It's going to depend on how quickly or slowly the situation, at least optically, responds to what they've done already. But they're going to load that thing up as fast as they need to. They don't want to have $10 trillion on the balance sheet, but that's where they're headed. I don't think there's any likelihood that they won't get there. I mean, as I said, there's no point guessing the pace of it, because it's the pace is going to change. There'll be periods where things are quiet, and then we'll see another aftershock come through, and then they'll ramp up the purchases again. And that's this thing is in motion now. And we saw what happened when they went from just below 800 billion before the crisis to 4.5 trillion with QE. We saw the unwind, which we were promised was going to be, quote unquote, Janet Yellen, as interesting as watching paint dry. And we saw what happened when the repo markets started getting a bit fidgety late last year. And when something like the repo market gets messed up like that, I go back to 2007 when the TED spread started acting up. And the TED spread wasn't something that everybody looked at. It was fairly arcane to finance type people. In hindsight, it was clear the message it was sending, that the plumbing was not working and there was something systemically wrong. We've had the same thing with the repo market back in October, and people said it was nothing. People said it was going to die down. Jerome Powell came out and very deliberately made sure everyone knew that it wasn't QE, even though it was QE. And now looking back in hindsight, maybe that was the signal and people just ignored it. So things are gummed up, and the system isn't functioning properly. And this is not a new system. This is a system that was, in the ordinary course of events, reaching the end of its useful life, given the amount of indebtedness it's fostered, given the fact that interest rates had hit the zero bound. This system was on its last legs. And that, if you think of the system as a patient in an ER room with the coronavirus, it's struggling to breathe, and you can do everything you want to save it. I don't think the system is salvageable. I think we're going to have to let this one go, and the question really becomes, what does the system that replaces it look like? And that's where I think a lot of the serious policymakers are starting to do their thinking. A lot of serious analysts are doing the same thing, and investors need to start doing that too, trying to think about what the system will look like once they come up with whatever cure they have for the problem that ails the patient, because it's a serious problem, and the treatment is going to have to be radical.
Yeah, I totally agree. I think the coronavirus was the pin that popped the everything bubble and the debt bubble. It's also, the coronavirus is going to be the scapegoat, the excuse, because the politicians say, don't let a good crisis go to waste. So whatever some of these politicians were planning with maybe a Fed coin, a cashless society, a crypto yuan, a crypto euro, a crypto dollar, a crypto yen, that might be accelerated in the next couple of years because of this crisis. And so many people are going to be, let's say, more open to government trying to provide them security. But I go back to the old Benjamin Franklin quote about freedom and security. People who choose security over freedom end up with neither.
Yeah. Look, people in times like this will grab onto anything that's thrown at them that looks like a life belt, and that's the phase we're in now.
So you talked about the bond market, and I think that's really important. I've spoken with different contacts. I have a podcast listener who's an upper management at one of the ratings agencies. I won't say which one. And I got some information from him about what was happening in the last couple of weeks. Seems like the European banks got stuck with a bunch of leveraged loans that they couldn't offload to pension funds and Japanese banks anymore when the game of musical chairs ended. The bond portfolios for a lot of these investment banks, whether they're bond fund managers. I was told that bond fund managers of some of these investment banks were told by their risk officers and their bosses to be enormous net sellers to reduce their exposure, even in investment grade corporate bonds, down 90% immediate sell. Everyone was trying to hit the exit at once. If that's happening, then who's going to buy these corporate bonds? And do you expect a lot of credit ratings downgrades then in the near future? Or does that not matter with the credit ratings downgrades if the Fed is going to come in and buy almost all the corporate bonds?
I think that the biggest question that everybody needs to ask themselves is what happens with the multi-trillions of dollars sitting just above investment grade, because the ratings agencies have intimated that cuts are coming in ratings. And there's a huge amount of debt sitting there above junk, which at the moment, technically speaking, the Fed can't buy, and neither can many pension funds, neither can many asset managers. So there's going to be another wave of selling in the bond markets with, at the moment, no backstop. I suspect the Fed will end up in the junk bond business. I suspect the Fed will end up in the equity business. And people are thinking that perhaps that means that it's okay to buy this stuff because the Fed are going to come in and buy equities. And they might. But think about the conditions that the economy is going to be in that will dictate the Fed are buying equities. It's a really unpleasant situation. And the valuations on these companies are way too high. I suspect they will struggle to get the kind of buy-in they'll need to spend trillions on the equities of overvalued companies. And at this point in time, I imagine there'll be plenty of equity investors who are going to get wiped out when these companies get restructured or quote unquote saved.
Did you see the Bruce Richards interview on Bloomberg a couple days ago? He's a bond fund manager, I guess. He's like up there with Jeff Gundlach, and he was talking. He said he thinks that the Fed is going to have to buy at least half of all the investment grade corporate bonds. So at least 3 or 4 trillion, he was saying on the Bloomberg interview.
Yeah, those sort of numbers don't surprise me. Howard Marks just published one of his fantastic memos. And he spoke in there about the fact that we'd had so little issuance, and suddenly in the 1 week when the Fed come out and announced that they're going to be buying this stuff, we had an extraordinary amount issued. In fact, there was more issuance last week, he wrote, than in 9 of the 12 months of 2019. There's 49 companies found a window in last week to issue $107 billion of investment grade bonds. A week prior to that, you would have bet every cent you had that no one could get an issue away. So everybody's desperate to raise money. They'll raise it where they can, when they can, but a lot of it is going to end up on the Fed's balance sheet. We haven't seen the wave of bankruptcies that we're going to see yet. That phase of this has not come to pass yet, but it's coming. There's absolutely no doubt it's coming. So to try and buy the dip one more time ahead of that it's not even picking up nickels in front of the steamroller. It's picking up squashed bottle caps in front of a steamroller.
Was it every single Dow company that issued in the last week? I saw some statistic of that, of someone, a financial professional using a pseudonym, pen name that I follow on Twitter. I think he said like almost every single one of the major companies in the Dow, I think, raised debt issuance in the last week or so.
I didn't see that. I mean, it may well be the case. It wouldn't surprise me if I think it's one of those raise when you can, not when you need to, right? So it wouldn't surprise me in the slightest if that did happen. Not in the slightest.
Well, we saw ExxonMobil raise another, what, 8 or $9 billion after one credit ratings downgrade, and they got warned by S&P credit ratings about another credit ratings downgrade. So that's two potential credit ratings downgrades for ExxonMobil in a couple weeks, and they still raised with debt. And then Carnival Cruise Lines just did, I would say they're borrowing money at what a junior mining stock would borrow at 13%. So, and they had to put up, I think, all their cruise ships as collateral.
Yeah, and then they pulled the European trench. I saw that. So, but look, they're not doing that because they want to. They're doing it because they have to. So what does that tell you, right? I mean, these assets are going to be up for sale. The assets are going to be up for sale. But this is the cruise line is going to struggle mightily to get a bailout. They're raising money, and I'm sure in the quiet conversations between issuer and investor, there's plenty of hint about the fact that they're in line for a bailout. I think they'll struggle mightily to get a bailout for the cruise line industry, but we'll see. You know, we don't know. All we know is this time around, everybody is going to need a bailout, and I mean everybody, right? The corporate sector is going to need bailouts. The small businesses are going to need bailouts. Individual households are going to need bailouts. And where do you draw the line as a politician? How do you possibly tell someone there that, yeah, sorry, everyone else but you gets a bailout? You can't do it. So they're going to have to come in and bail out everybody. And all that is going on the balance sheet. It's pretty much baked in the cake at this point.
Well, everyone's not going to get the same amount, Grant. It looks like the large corporations on Wall Street, they're going to, and the friends of the people in Congress in both parties are going to get theirs. And the average guy on Main Street, maybe he or she's going to get a check for $1,200, a couple of these checks, but that's nowhere near what they were getting at some of their jobs.
No, well, no, absolutely right. But at the end of the day, the problem here becomes you have to say no to somebody, right? And we know what the inclination is going to be. The inclination is going to be to say no to the poor man in the street. But don't forget, this is an election year, which changes an awful lot of the dynamic. When you need votes and you go and bail out quote unquote corporate fat cats, and the poor downtrodden worker doesn't get his, then that's a problem for you in November. And I think they're savvy enough to realize that.
So now that we're in a clear crisis, you talked about helicopter money. I think people need to either go and read Ben Bernanke's 2002 helicopter speech or reread it, talking about how central banks can fight deflation, because they're going to be going off that. But the other important thing that I've stressed, because I've studied financial history, I know you're big on that too, is the rules changes. So we're going to see rules changes, whether that's accounting rules changes, what the Fed is allowed to buy, what the European Central Bank is allowed to buy. We're going to see rules changes fast and furious now, I think, going forward.
Yeah, look, I suspect you're right. I mean, they're going to be dynamic, they're going to be fluid, they're going to be reactive, they're going to change the rules all the time because the game's going to change. And we've seen this movie before in 2008. We saw how they had to change everything as they went along. And the same is going to be true here, but the stakes are much, much bigger this time because, back then they had some more bullets in the gun. In the intervening decade, they've already fired most of those bullets. And so they're going to have to get very, very creative. And there is a limit to how far that creativity will take them, I would imagine. We're going to find out, though, I guarantee you.
The other major thing here, Grant, I think, and I called this in the first week of January, one of the most important stories for all the markets was the dollar. So you have a dollar tug of war. You have the President Trump, the Trump administration, the Fed, the US Treasury. They don't want a strong dollar. They want a managed decline of the dollar, a controlled devaluation of it, so hardly anyone notices. And yet the dollar index recently, it just took off. So the dollar index was wobbly. It was a roller coaster the last 5 or 6 weeks where it almost collapsed. Luke Groman and others were talking when the dollar index got below 95 that it was in terminal decline. And then it had a rip your face off rally for a couple of weeks there where the Fed, I think, had to step in. They had to promise all these asset purchases. I think they were doing another bailout to try to announce these press releases to try to weaken the dollar any way they could by promising spending. They got the dollar index temporarily below 103. Is the dollar going to keep rallying? Is the dollar going to collapse? Or is the dollar going to just stay in a weird trading range and no one's going to be right? What do you think the end game is here for the dollar, and how long will this volatility stay?
Well, I think the answer to your question is both. I think the dollar will rally and it will collapse. How long the rally lasts for me is the big question. And Brent Johnson has done a great job of talking about this in his milkshake theory. And he's been wrong for a while, and he's been very right recently. The dollar's weakening now. I mean, the one thing I would say is that the strong dollar is in nobody's best interest, really. I mean, Brent will make an argument that it's in Trump's best interests in a way, but right now it's killing everybody. And so I suggest that it won't be allowed to get out of hand. It won't be allowed to get to the kind of places that Brent makes a very good case it'll go to. And it will need to be managed lower, like we saw back in the 80s with the Plaza Accord. This is out of necessity, not anything else. So, the dollar is one of the most important questions that people need to understand and have a view on. But, I believe it goes lower, but I understand completely that I could be very painfully wrong in the short term.
Yeah, for now I'm dollar neutral because I think it's a tug of war where there's two forces pulling against it. Anytime it looks like it's about to collapse or anytime it looks like it's about to get above 103, someone comes in, intervention, rules are changed. I mean, look what the Fed has done. In a week span, there was 2 press releases for currency swap lines. I can't even tell you how many financial professionals that that have told me that currency swap lines were a lie. They didn't exist in 2008 and 9. They were tiny. People were sending me links to the Fed's balance sheet claiming that I made it up. And here we are, 2 press releases for currency swap lines in a week. And then on top of that, yesterday, the Fed announces a global repo for the other central banks too. And that's at least 6 months. And there's no cap on that. I was looking through the press release. There's no 500 billion repo for the central banks. There's no limit from what it looks like.
Sure. Yeah, no, absolutely right. But again, right, just we have to understand the desperation these guys are facing, right? They are desperate in the true sense of the word, and they will do absolutely anything it takes to survive. Draghi's whatever it takes is where they are. They will do whatever it takes to survive because they're all in now, right? They've been doing this for a decade. If you want to go, you can take this back to Greenspan, right? And the Fed put, if you want to. That's a very easy set of dots to join. But they're all in, and now they've taken this decision. Now they've made this choice. They can't back down because to back down is to hold your hand up and say, yeah, okay, we were wrong. And we all know that the Fed is a confidence game. So if they ever admitted, God forbid, that they were wrong, all hell would break loose. So they don't have that option. They don't have the luxury of admitting they're wrong. You realize that, then you realize that they have to stand there and fight. They have to stand there and fight.
Sorry to interrupt you. There's also no accountability there. I mean, how many Fed people have you seen fired? I mean, normally it's Peter principle, right? Normally it's a seniority system like a government bureaucracy. If you're there a couple of years, you're due a salary increase and a promotion.
Yeah, but I mean, look, that's an irrelevant statistic. It doesn't matter how many people have been fired. We're not going to look through the wanted ads at the Federal Reserve. It doesn't matter. Most of them are PhDs working in a basement on crazy models that spit out ridiculous numbers. So it doesn't matter, right? This is not about how do we get even with the Fed. They've done initially what they thought was in the best interest of the economy. But I think the longer this has gone on, the further it's gone, they have changed, and their motivation has been about self-preservation and protecting their legacy. And that is an awful thing to realize it's true, but I suspect that's exactly the case. This has been about saving face. This has been about making it clear that it wasn't us that screwed the pooch here. But the reality of it is, it's them. I think that being able to join the dots from Fed policy to many of the problems we find ourselves facing, it's not many dots you have to join. It's a handful.
Yeah, I completely agree. I mean, I was just talking about accountability where if they were private, if they were an economist at a private company, right, and they had this type of horrible track record, they probably would have been fired.
Yeah, no, look, they definitely would have been fine. I mean, it's tough to find a period in time where they were wrong, but in fairness, you have to understand that they have a reactive role, right? They're there to react to the financial to the economic situation. They're not necessarily there to be ahead. You know, McChesney Martin said their job is to take away the punch bowl when the parties, got started, not to take it away before the party gets started. The mistake they made was, they didn't take it away because every time they tried to, everyone left the party, so they had to keep that going. And now those chickens are coming home to roost, and it must be a pretty confronting thing for these guys to have to face. But face it, they must.
You talked about the Plaza Accord. So do you think the Fed will try everything else first, and then the last two solutions the Fed has, and we go back, I know you love history, financial history, I do too. So the last two solutions the Fed tried that were able to devalue the dollar after they tried other things were the Plaza Accord, like you said, in 1985. The other one, and I think the Fed does not want to do this because it makes gold look good, is what FDR did in 1934, devaluing the dollar against gold.
We can all sit here and we can all try and figure out what they're going to do. The simple answer is they will do anything, right? So trying to work out how this thing plays out when it's unprecedented what is going on is a very dangerous game to play. We know their motivations, which are keep the system together. I think that's going to prove to be a losing battle. I think gold will come back into the monetary system, even if it's just temporarily, because something will be needed to stabilize it. And I did a presentation about this called Cry Wolf a year or so ago, where I talked about the conditions you needed and how this would happen. And I suspect that is in our future. But everything is going to be so fluid. I mean, decisions are going to get made. Look at what the Fed have done in the last 10, 12 days. The number of new programs they've put out. They didn't do them all at once, and I'm as sure as I can possibly be that they didn't have all these things lined up and they were just piecing them out one by one. Every new acronym facility that gets thrown at us is an on-the-fly audible that they've called to try and stick their finger in another hole in the dike, and ultimately they're going to run out of fingers and the dike is going to break. But that's for a time in the future that we can't determine. So it becomes about understanding how severe the situation is, understanding that at the moment it's about risk mitigation, unless you're a very adept and very talented short seller, and try to preserve your capital and try not to give up a huge swathe of your pension fund or your savings or your trading capital, whatever it may be. This is a time to play defense.
Yeah, all the bailouts and all the stimulus programs and plans being announced, it reminds me of FDR's first 100 days in office, all the New Deal programs that were being rolled out, which were doubling down and tripling down on Herbert Hoover, which the history books have labeled him as a capitalist, an evil free marketeer. But studying the Great Depression in 1929 shows the exact opposite. He was a heavy interventionist and tried a lot of different things.
Right. Yeah. No, I don't disagree with that.
So I know you have a lot of contacts in the gold market. How big are the shortages in the gold market that you're hearing for physical gold?
Well, look, for the most part, the problems are logistics, right? The problems are flights being cancelled, people being unable to either get gold from one place to the other or produce finished products from doré bars or to get stuff smelting down in the refineries and produce finished products. On top of that, you've also had a concurrent demand shock as well. You've had a lot of people rushing into gold, so it's amplified that. Once again, there are things happening in the futures market which people who look at the gold markets closely understand are saying something is very wrong. You don't have the futures trading at a 100-point premium. It just doesn't happen unless there is something wrong. Now, at the moment, it's been put down to these logistical shortages and problem getting certain specification bars in the COMEX and having to use London bars, and they've put sticking plasters on this again by coming up with a new contract on the COMEX. So again, band-aids are being applied to try and smooth this thing over, and for the time being, it's calmed down. The same way the TED spread calmed down back in 2007, the same way the repo market kind of calmed down a little bit back in November, but these are systemic problems. And if you look at the number of claims outstanding on the gold in the COMEX warehouse, if we do have a simultaneous demand and supply shock that makes people want to secure the ownership of the gold upon which they've got a claim, then all hell will break loose. You will not be able to buy gold, there'll be defaults, there'll be force majeures, there were all kinds of things going on, none of which will be negative for the gold price. But people spend way too much time looking at the gold price and not looking about what gold does and why you own it. And I've said this before to someone else this week, this is the perfect example in the last month or so as to what gold does. On February the 22nd, at the all-time high in the stock market, an ounce of gold would buy you 0.49 of a unit of the S&P. The S&P falls 35%. Gold is unchanged. It was actually up 1%. And everybody was screaming, saying, why the hell hasn't gold gone up? It's supposed to go up. What the hell's wrong with it? Something's wrong. I told you gold doesn't work in a crisis. Well, by just going up 1% versus a stock market that was down 34%, your purchasing power of that gold against units of the S&P went up by 33%. You could buy 0.64 units of the S&P after that. That's what it does. That's what it's there for, to protect your purchasing power. So the price is not the be-all and end-all, and the only people who should be focusing on the gold price are the people who are trying to trade it and make a quick profit, or think it's run too far and it's going to correct, whatever it may be, but it's just a trade for them. If you're investing in gold, you need to think of it differently.
To add to your points there, you also have gold mining companies and gold refiners that are normally, they're running full blast, especially at the current prices. The gold mining margins would be very good with oil prices collapsing since the first week of January, but you have a lot of countries forcing precautionary shutdowns for 14 days, 15 days on many of these gold miners. So that's exacerbating the squeezes here in the bottlenecks in the supply chain.
Yeah, look, we haven't seen those numbers feed through to the bottom line in the gold companies yet, and the gold companies have had a shakeout of their own. They didn't perform very well, but that will change. If the conditions or the prevailing conditions continue, it only gets better for gold with each passing day. And at some point, we're starting to see it now. The tape's down 3.5%, 4% today, and the gold stocks are all up. Not huge, but they're up between 1% and 5%, which is an astonishing performance in a tape like we have today. So people are starting to get the message, and when that message goes mainstream, there is nowhere near enough paper of these gold companies to satiate the demand that they're going to see. So they will have their day unless some kind of magical cure to all this drops out of the clear blue sky. The gold mining companies will have their day. And I don't actually think people are prepared for the kind of explosive action to the upside that we will have in gold stocks, particularly the juniors, when it becomes clear what the situation is all about and when all the sellers have been taken out.
Plus, a lot of these gold companies can't really raise capital right now. And once these gold miners are back online, if the oil and energy prices stay at these levels, I mean, the margins are going to be very robust. Some of the best in the history of some of these gold miners for a very, very long time.
For sure. I mean, if you're a gold miner, you can hedge your oil price down here. I don't think they have any problem raising capital. Maybe they do it in the private markets, but there won't be any shortage of smart investors who want to put capital to work that will be happy to lend it for a decent coupon to a well-run gold company that can hedge their biggest input down here. I mean, it's a no-brainer, but that may just not be reflected in the public markets yet. But like I said, if this situation continues to unwind the way it is, it will happen.
Yeah, most of the capital being raised has gone into the gold mining stock ETFs, gone into the larger royalty and streaming companies, into physical gold, and then also to the gold trusts. So like the Sprott Physical Gold Trust, Sprott Central Fund of Canada, those types. So the individual miners, like some of the producing miners are raising capital, but a lot of the other miners, the smaller producers and the juniors, they might have gotten money a couple months ago for a drill program, but nothing more than that to go and build a mine not yet, at least. I want to ask you about the oil market. So the oil market, what has happened, I think, in the oil market in only the last 2 or so months is incredible. I've never seen anything like it. I've called it, and I was an oil analyst for my day job. I've been around for oil bust bear markets before 2008, 2009, 2013, and 2016. Do you think that have you seen anything like this before in your career? Because you've been in the financial industry longer than I have. It seems like this is the perfect storm of bad bear market news for the oil market.
Yeah, look, you're absolutely right. That's exactly what it is. It's been a perfect storm, and that perfection is reflected very clearly in the price of oil. It's also reflected in the fact that most analysts are now, even down here, talking about they're talking about oil, going down to $10. We're not quite at the despair stage yet, but I mean, when a barrel of oil costs less than a bucket of Kentucky Fried Chicken, you know what you should be buying and what you shouldn't be buying. And for people who have the ability and the capacity to buy oil down here and have a long enough time horizon, I mean, it's very difficult to see a world in which these prices continue, given the fact that every central bank in the world is going to be printing paper. Every government in the world is going to be issuing debt to pay for social programs. I mean, the chance of oil staying down here for too long are very, very small indeed. But again, it's one of those trades that you have to be brave and step in front of and run the risk of getting run over for the initial days, weeks, maybe a month or two.
Yeah, I think it's still a falling knife. I'm waiting for the larger oil companies because their dividend payout ratios are way above 100%. Some of them, their dividend payout ratios are over 200% now. And in the past, I've gotten burned trying to buy stocks with a high yield and not paying attention to the dividend payout ratio. So I'm waiting for those dividend cuts or those dividend suspensions, waiting for some credit ratings downgrades. I think there will be more blood in the streets. I'm not going to buy all my oil stocks at once. But I think at some point, maybe 6 months, maybe 12 months, who knows, sometime around that time span, once more bad news is priced in, I think this might be the best buying opportunity for some of these really quality oil stocks because the baby is being thrown out with the bathwater in the last couple decades. I don't think we're anywhere close to the bottom. Do you think we're close to the bottom then?
Well, I don't know. I defer to your superior knowledge of the oil market itself, but having looked at oil for 35 years, to see a fall like this and think that you're not going to see some kind of bounce. Look, put it this way: when you talk about 12-month time frame, I don't think there's any way oil is down here for 12 months. We can have this conversation again in 12 months, and I might have it all over my face. But I'd be astonished, given what is going to go on in the basements of the central banks, that the most in-demand commodity in the world is trading down here. Now, yes, the lack of economic activity is going to be a massive hit for oil, but countries are going to be filling up their SPRs. The Chinese have already talked about doing it. The US have talked about doing it. People will be digging holes to put oil in at this price. So I don't think there's any way you have a 12-month period where it's down here. I would think in 12 months it would be significantly higher. But again, like everything, when you're in markets that are this dislocated, you have to pick your time to step in front of the train, knowing you could get hit, and you don't put all your money to work at once, because that would just be incredibly foolish. But if you think these things are falling too far, at some point you have to establish a position and give you something to trade around. And for me, oil in and around here, we may not be quite there yet, but I think we're a lot closer to buying it than we are to shorten it down here. That's for sure.
Yeah, and the rules are going to change because even the state of Texas is talking about re-implementing production quotas with the Texas State Railroad Commission. That was the cartel before OPEC. So a lot of people aren't familiar with the history of the oil market. The U.S. had an oil cartel before OPEC.
Yeah, look, again, this is a systemically important industry, and they will do what they feel is necessary to try and shore it up. The U.S. is oil independent for the first time in a generation, and that's an important ace to have up your sleeve. So the oil industry is absolutely going to be supported, and the thing they have to do now is get the price up, and there are ways to do that on the supply side. So changes will come, and all the changes you're going to see in the oil market, whether it's at at a regulatory level or whether it's at a company level, everything that you see done is going to be geared towards getting the price higher.
Yeah, I agree. The question is then how many oil companies go bankrupt before that happens?
A lot, absolutely a lot. But how many are there, right? There's way too many, because everyone with a shovel could raise money and go and dig in the Permian. So a lot of these things deserve to go under, and that's fine, right? This is what we saw in 2000. We saw all these companies go bust, laying fiber optic cable, and that gave us the backbone of the internet and allowed for us to have $14.99 a month internet, because all the money was written off in building infrastructure. The same will happen in the oil market, and a lot of these companies that go bust were poorly managed, had too much debt, and deserve to go to the great wave spin in the sky. That's capitalism. So this is what's supposed to happen, and we've been trying to avoid this happening for some considerable amount of time, and here it is. And so now, instead of trying to save the whole system, you're going to have to pick and choose. And it's going to be very difficult to say, this oil company needs to be saved, when it's pretty clear to anyone looking at it, no, it doesn't.
Yeah, and President Trump's talked about a bailout, so we'll see what happens. I mean, the rules are constantly changing. Who knows if they're going to get one or not? I think there's still going to be bankruptcies, and not everyone's going to get a bailout. But I really enjoyed our discussion today, Grant. You've given my listeners a lot to think about. I think you said one of the main things people should pay attention to are those corporate bonds, probably junk bond market. And it looks like these central banks, whether that's the European Central Bank or the Fed, are going to have to buy up a lot of these leverage loans, asset-backed derivatives, they're calling them, and bonds, corporate bonds.
Yeah, look, they'll call them whatever they have to call them to make them viable under whatever authority they manage to conjure up. Whether they have to do these things through an SPV, they'll find a way, because they have to. They don't have a choice now. And I think a lot of people, particularly in equity markets, are trying to front run that. But for the Fed to buy stocks is going to be, I suspect, I firmly believe they'll get around to doing it somehow, but I think the road from here to there is going to be slightly longer, and contain a few more twists and turns than people perhaps think. So I think if you're buying now to front run the Fed buying stocks, you're a little early.
Well, the Republicans caved like a lawn chair to MMT-QE. So, I mean, the Republicans had no backbone. They immediately caved. I was pretty shocked how quickly they caved. So who knows? I mean, we'll see.
Jason, it's an election. Listen, it's an election year, right? That every investor, that should be the first lens through which they look at everything, right? Because you have people in power who stand potentially to lose that power. At the moment, they have all the levers to pull. And believe me, the thing they care about most is being in power still come November the 21st, 2020. So every decision they make is going to have 1 to 1.5 to both eyes on how does this help our re-election chances. So you need to look at every decision you make through that lens first and foremost, because that's how the people who are going to make all these rule changes that we're talking about, that's the way they're going to be looking at it.
Exactly. 100% agree. They will buy votes if they can. I want to thank you so much for your time today, Grant. If my listeners want to follow you on Twitter and take a look at your newsletter, how did they do so?
Yeah, by all means. You'll find me on Twitter at TTMYGH, which is things that make you go, And the website is the same, ttmygh.com.
Excellent. Well, I always enjoy our discussions. You're doing a fantastic job. You are an excellent follow on Twitter. And those gold videos with the graphics you have and the analogies are just absolutely superb.
Well, that's very kind of you, Jason. Thank you. And you keep up the good work too.